I have had my primary residence for the past 21 years. If I rent it for 3 years or more and sell it, would I be taxed on the depreciation I take over those 3 years? Or would it be included in the 1031 or the 121 exclusion? I'm immediately going to that 1031.
Right?
Bad Toby.
Yeah, no, well, there's a lot going on in this question, actually. It was our primary residence. First of all, let me go back to what 121 is. That is the exclusion. If you sell your primary residence, if you meet the conditions, which we'll go over, then you can exclude up to $250,000 if you're single, 500,000 married filing joint. So what this individual is trying to get at is they've had their primary residency for many, many years. They've owned it, used it as their primary residency for over 2 of the last 5 years. That's the 121 rule. But then they rent it for 3 years. And if it was exactly 3 years, then they could take advantage of that 121 if they were to sell it, and maybe even the 1031, as Toby was kind of alluding to there. But if they go over that 3 years of rental, then they go outside of that. You owned it 2 years within the last 5 years for the 121 exclusion, meaning they wouldn't get any exclusion if they sold it. So it's right on the borderline that they picked that 3 years. However, the fact that they did rent it, let's say they only rented it 1 year, but they'd had it the past 21, well, they could use that 121. They've owned it, used it 2 of the last 5 years, get the exclusion. And then because they put it in a trade or business, as Toby was going to, you could do the 1031, which we alluded to earlier, and maybe defer some of that gain. No depreciation recapture in that case. Otherwise, yeah, you'd have depreciation recapture.
So let's play some scenarios here, and let's talk about what you could do to avoid having a negative occurrence. So what we have is the 121 exclusion, which is a capital gain exclusion. If you're married, it's 500,000. If you're single, it's 250,000 of capital gain, not recapture, capital gain. So if you rent your primary residence, the rule is if you've lived in it 2 of the last 5 years, used it as your primary residence, when you sell it, you get that capital gain exclusion. 2 of the last 5 years. So that's why if you lived in it and then you moved out, you actually have 3 years of which to take advantage of the 121 exclusion. There's one other caveat. You could not have taken a 121 exclusion for 2 years, right? So you can't do more than once every 2 years. So if you moved out of your primary residence, rented it 3 years, but in 2 of those years bought another primary residence and then sold it in 121, you'd be ineligible to do it because you can only use it every 2 years. So let's just say that's not the issue. You moved into another place and you're going to keep this property and you're like, oh shoot, I'm going to lose this capital gain exclusion. So let's use some facts. Let's say that you bought this primary residence 21 years ago for 250,000. Let's assume that it's worth 750,000 now. So we have $500,000 of gain. If we sold it right now, you would have zero tax, none, because you have a 121 exclusion for 500,000. It would all be gone. Now let's say that you waited 2 years and the property value goes up to 800,000. And in that 2 years, you took depreciation that saved you 15,000. So you would lower your basis. 250 is what we bought it for. So we'd be down to 235. We'd have $500,000 of capital gain exclusion. So that would get us up to what, 735. And anything over that, let's say we sold it for 800,000, would be taxable as we'd have some recapture on the 15,000, and then we'd have some long-term capital gain. If you want to avoid having to sell it and you just want to grab that $500,000 of exclusion and you want more depreciation, let me give you the solution. You are going to sell your primary residence right now to an S Corp. You're going to set up an S Corp and you're going to buy it from the S Corp. Here's why you're doing that. Because when you do that, the S Corp is a separate taxpayer, according to the IRS, and this has already been vetted out. The S Corp could now buy it on an installment contract, which we can't treat it as an installment sale for tax purposes. It won't matter here in a second. But that way you're getting payment. The rent's basically coming out as a payment. And you're going to see why it's not going to matter, because you're using the capital gain exclusion to have zero taxable income. But now the basis of the property is that 750,000. And now you could rent it out and depreciate it 750,000. How much taxable income will you have from it? Zero. I mean, it's gonna offset that income. All right, so we get the capital gain exclusion, and now we could just hold on to it forever, right? And if you ever wanted to sell it, you could 1031 exchange the difference. Now you have a new basis of 750,000, and then you sell it, let's say in 5 years, 6 years, and you want to buy other investment property, and this thing's now worth $1 million, you could sell it and pay no tax. Your basis is still that 750 minus the depreciation. So it ends up avoiding the tax hit completely. If you lose that capital gain exclusion, that is worth at a minimum to you, probably about 15%, probably closer to 20. 500,000 is going to be at 20 if you have any other income. So let's just say it's going to cost you, you're going to lose about $100,000 of tax benefit. So we may want to take advantage of that, step up your basis, you keep it. And I know people are freaking out going, you're in an S corp though. Yep. Don't take it out. Don't refi it and take it out because that could be taxable, but you have a new basis set, right? It's only on the value of that it goes up. So it doesn't hurt us to have that S corp. The income made inside of an S corp keeps its nature, so it's still passive rental income. We get a higher amount for depreciation. It's cash flowing out to me. I'm not having to pay tax on it. If there's interest, I might have a tiny amount of interest that it has to pay me. But boy, what a much better scenario than losing that 121 exclusion. And I'm sorry if I lost some of you guys, but this is the way that a tax planner thinks.
Yep. This has so many options to it. A lot of good stuff that you can do here.
Yeah. The other route is you just sell it within 3 years. Like I live this. I had a primary residence that I moved out of, about a year and a half ago, and I just made it into a rental, like furniture and everything. I just rented as a corporate rental. So I have 3 years from that date that I moved out to either do the S corp and sell it to it, or just to sell the property and use my 121 exclusion. As of right now, I'm more than my 121 exclusion, but it would still, I could use the 121 exclusion and the 1031 exchange because now it's an investment property. You use the 121 exclusion to offset the capital gain first, you use the 1031 to offset recapture and any other gain. So you could do both, believe it or not. It's kind of crazy. The IRS shows us how to do it. It actually spells it out and it anticipates that so that you could do it. And it works out great. You could actually buy a replacement property and get this, rent it out for a little while and then move into it. The 121 code actually anticipates that and says, hey, you can only do that every 5 years, right? Because it's such a huge tax savings, especially for you guys in California and New York, where your properties have gone up $2 million or something. What the trick there is, take your property that was your residence, turn it into an investment property, do the 121 and the 1031, acquire a new property as an investment property that you might move into in 2 or 3 years, and then move into it. And it works like a charm, like crazy good. All right. Anything I missed on that?
No, I think we give them enough.
Are your brains hurting? Hey guys, if you like this snippet of Tax Tuesday, then I invite you to click the link and actually subscribe to become a Tax Tuesday member. Every other week, we do these live, and you too can ask your questions, and myself and my team will answer your questions on the next Tax Tuesday.